if you're a first-time attendee, featuring Zacks strategists providing their analysis of the latest issues and trends affecting investors, including but not limited to the current issues and trends affecting the market, the economy, both globally and here in the U.S. Today, our research director, Sheraz Mian, and Tim Nyland, managing director of Zacks Institutional Services Division, will be wrapping up the first quarter earnings season and taking a little bit of a look ahead to what they see for the rest of the year, not only for earnings, but for the stock market as well. So Sheraz, with that, we're going to start with you. Based on the Q1 earnings season shaping up to be not as bad as originally expected, you and I had been talking about that in other instances, albeit due to lower expectations, and with Q1 almost totally in the books now, are you viewing this as an inflection point of sorts for better things to come later this year regarding earnings?
It potentially could be, and it's not 100% clear from the data as of now, but the possibility is there. And as we go further along in this presentation, I'll explain what I mean by that. But the overall expectation for Q1 was for fairly weak earnings, and we got the weak earnings. The inflection component refers to the relatively decelerated pace of negative estimate revisions for the current period, meaning for the June quarter. And I explained that a little bit later too. The bottom line is that we got what we expected. Expectations were low, so most companies come out with positive surprises. The question is, what happens to estimates going forward? The results we have seen thus far seem to be indicating in a relatively favorable direction. But we will know for sure after the Q2 earnings season comes around if we see a similar deceleration or even an improvement on that front. Then it will confirm that Q1 was an inflection point. Q1, as you know, was the fourth quarter in a row of earnings declines for the S&P 500. And that is expected to carry into the second quarter as well. But the hope is that in the second half and beyond, things turn around. So with that relatively long explanation, excuse me, let me jump into the data. And the first slide that we have here is the earnings scorecard for Q1. This has data as of the close on May 9th. In total, 444 S&P 500 members have reported results as of the end of May 9th. With two indexes members have reported this morning, the numbers go to 446, but the overall growth numbers and the overall trends don't really change much since last evening. Before I explain this relatively busy-looking table in some detail, I think it's useful to point out that we use net income and not EPS for calculating the growth rates. The reason for using net income is that we don't want our growth numbers to be impacted by the heavy buyback volume that has become the norm in recent years. Another thing that needs to be pointed out is that our measure of net income that we call as net income BNRI before non-recurring items is slightly different from other data vendors in that we use or include employee stock options as a regular operating expense. Others don't. So I get this question quite often from clients and media persons as to why our numbers are different. The reason for that is simply the treatment of employee stock options. So with that, you could see on this slide that 88.8% of the index members have reported results. Total earnings for these 444 S&P 500 members are down 7.4%. Total revenues are down 1.5%. 71.2% are beating earnings, and 55.9% are beating revenues. As you can see, the third row on this slide, retail, which shows that 48.8% of the retail sector results in the index have come out already. So retail is the only sector in the index at this stage that still has a sizable number of reports still pending. For practically all of the other 15 sectors, the earnings season is behind us. The last row of this slide looks at the aggregate data on an ex-energy basis. We all know that energy has been a big drag on the aggregate picture over the past year, year and a half. And as you could see towards the bottom third of this slide, which shows the oil's energy sector, total earnings for the energy sector are down more than 100%. So on an ex-energy basis, earnings for the S&P 500 would still be in the negative, down 1.4%, though revenues would be in the positive, up 2%. So let's put the performance in context, and that's what we do in the next slide. It's basically two charts, two side-by-side charts. The left-hand chart compares the Q1 growth rates, the earnings and revenue growth rates, with what we had seen from the same 444 index members in the recent past. And for the recent past, we are looking at the 4-quarter average and the 12-quarter average. And as you could see, the green bars are earnings, the orange ones are revenues. The growth rate is notably on the weak side. But when you see in the right-hand side chart, which compares the beat percentages for this sample of 444 index members, you see that a relatively bigger proportion of companies are beating estimates. So 71.2% earnings beats compares to the 4-quarter average of 69.4% and 69% as the 12-quarter average. The same is on the revenue side. More companies are able to come ahead of top-line expectations as well. So more numerous positive surprises. Most likely that's a function of what Mr. Ruffalo was referring to at the top of this segment, that expectations were very low. I think some credit needs to be given to the pullback in the exchange value of the U.S. dollar as well. I don't think that's a big driver of this outsized positive surprises, but it still is helping on the margin this part of the earnings cycle. In the following chart, we look at the growth comparisons on an ex-energy basis to get a sense of the underlying growth momentum in the index, taking out the drag from the energy sector. And as you could see, now here, the left-hand side chart is the aggregate picture for the index that we discussed earlier. The right-hand side chart looks at the same growth data, but on an ex-energy basis. As I mentioned earlier, earnings would still be in the negative on an ex-energy basis, though revenues turn positive. But as you look at the historical comparisons, whether the 4-quarter or the 12-quarter averages, the Q1 growth performance is notably on the weak side. And that's not been a surprise. Expectations were low. Expectations were for negative growth. The key point and the key takeaway from this comparison is that the growth weakness within the S&P 500 is not entirely energy driven. There's not much offsetting growth from the other 15 sectors either. So when we go to the following slide, this gives us a composite or blended picture for the S&P 500 for Q1. We have put Q1, compare that to the preceding 2 quarters for earnings as well as revenues. Here we have the actual results for the 444 index members that have reported, and combine that with estimates for the still to come 56 index members, and looked at Q1 as a whole. Total earnings for the index are expected to be down 7%, and total revenues for the index are expected to be down 1.1%. The bottom row looks at the aggregate picture on an ex-energy basis. Total earnings for the index would be down 1.7%, even if we take out energy from the aggregate numbers. The revenues turn positive would be up 2.1% on an ex-energy basis. And as we briefly touched on earlier, Q1 is the 4th quarter in a row of negative earnings growth for the index. Very quickly in the next few slides, we'll be starting to take a look at what's expected for the current and coming quarters. So let's take a look at the next quarter. And what we are showing here is as to how the earnings growth expectations for the current quarter, meaning the June quarter, have evolved since the start of the year. As you could see, at the beginning of the year, earnings for the index were expected to be modestly in the positive, and they have steadily been coming down and currently stand at a decline of 5.6%. This is not unusual. We see this quarter after quarter. The trend has been particularly pronounced over the last 2.5 to 3 years. What is unusual, though, about this trend of negative revisions for the current period is that the magnitude and pace of negative revisions for Q2 is tracking below what we had seen in the comparable period in Q1. And that's basically at the core of that inflection narrative, meaning that the earnings picture has started to shift or has started to improve. It's still negative, it's still going down, but it is not going down as much as we have become used to seeing in the recent past. If we go back to that yes, the evolution, yes, exactly. One possible explanation for this is that in the prior cycle, in the Q1 negative revision cycle, estimates really came down hard. In fact, the negative revisions, the comparable negative revisions that we are seeing here for Q1 were off the charts, were at a record level. Part of that was what was happening in the energy sector at the start of the year, but estimates overall came down for all the sectors. And at the time when Q1 estimates were coming down, we saw quite a sizable magnitude of negative revisions for the Q2 period as well. So one could claim or argue that Q2 estimates had already fallen in solidarity with the Q1 negative revisions, and they did not need to come down as much. Another possible explanation will be the improvement in the dollar backdrop. We have seen the dollar lose some ground, and that apparently is helping on the margin this revisions trend. Again, we'll have to wait through July and August to see if we see this decelerated negative revisions momentum hold up for the Q3 earnings season or not. So if we look at this slide, this is giving us an overall growth picture for the S&P 500 as a whole. We have the orange bar in the middle, the -7% for the Q1 earnings season. We have the following 4 quarters, and we have the preceding 3. As mentioned earlier, Q1 is on track to be the 4th decline in a row for the index. This declining trend is expected to continue into Q2. Q3 is barely in positive territory right now. We'll see in July, August what happens to Q3 estimates if we see the deceleration and negative revisions that we experienced over the last few weeks in July and August as well. Then that will be a notable improvement on the earnings front, notwithstanding the fact that growth is effectively non-existent. The momentum improves or is currently expected to improve towards the end of the year and then carries into 2017. You could see that there's a 7.2% growth in the last quarter of the year, and then double-digit growth in the first quarter of 2017. The following quarter looks at the same data, but now shows it on an X-energy basis. We have pretty much the same momentum. Q1 is on track to be negative, but on an X-energy basis, this is the first negative. Q4 15 was barely in positive. Q1 is negative. Q2 is negative as well. And then we start growing, and there is a notable growth momentum from the second half onwards. 3.2% growth for the index on an X-energy basis in the third quarter, 6.9% growth in the fourth quarter, and an 8% growth for the index in the first quarter of 2017. So stepping back from the quarterly data and just a brief comment on the annual picture, 2016 is effectively a washout now as far as growth is concerned. It's modestly in the negative on an aggregate basis and modestly in the positive, low single digits on an X-energy basis. All the hopes are riding now on 2017 and 18. Current consensus estimates are projecting double-digit earnings growth in 2017, followed by another strong growth in 2018. 13% is the exact earnings growth we are showing now for 2017, and 11.5% the following year. We'll find out in the July-August earnings cycle as to how well those expectations can hold up as we go along.
Sheraz, I just want to follow up with something here on this whole lowering the bar scenario. You know, in the years that I've known you, you've always taken a pretty pragmatic look at this aggregate earnings picture, pretty realistic. So some people would argue here that the bar went so low that it was easy for companies to clear it without much effort. So the question is, has corporate America overplayed their hand here with this lowering of the bar, or at what point does that happen?
Yeah, the the proportion of companies that beat estimates typically is about 2/3 for earnings or EPS estimates, a little over 50% for revenues. And you are absolutely right. Management teams have really refined the art of anchoring and managing the street expectations. And this process has effectively robbed the proportion of the beat percentages or the beat ratios of any analytical value that would be of interest to serious investors. What we at Zacks really take note of is trends in estimate revisions, and it's the pace and magnitude of negative revisions that tells us really about the evolving earnings outlook, and it's this particular metric or this particular aspect of the earnings cycle that really tells us how good or bad the individual industries, sectors, and the overall corporate sector as a whole is doing on the earnings front. So it's management guidance, it's the market's expectation of how the business outlook is. That is the real takeaway from earnings reports. Stock prices reflect what is expected to happen in the future, not what happened in the past. To the extent that the past can tell us anything, it is to help us make up our minds as to how the business is and what can we use that and how we can use that to make up our minds about the business outlook for the current and coming periods.
Okay, thanks for that. Tim Nyland, you've been sitting waiting patiently to jump in here. Let's bring you in. You actually see lower expectations as being good for the stock market going forward, correct?
I do. I think some of those growth rates that we've been looking at here for the second half of the year and on into 17 are largely the result of low comparables for growth, and that's obviously a good thing looking out. It's no mystery that this bull market is an old one, right? It's the second longest so far in modern U.S. history. What we've witnessed since February is defiantly the S&P 500 has basically climbed a wall of worry to highs that we haven't seen since last year. So what I wanted to do, and I think Sheraz's presentation was an excellent segue into where I'm going to start, is to just take a look at 10 talking points that listeners can really share with their clients and take away and give you guys some thought as to 10 really good reasons to remain bullish. And the first one is that low comparables. And what I did in the Zacks research system is I took a look at a bottom-up reconstructed composite proxy of the S&P 500, and I market weighted it. These are available to all ZRS users. It's the SP5M is the ticker symbol. And just like Sheraz mentioned, I don't look at any of the diluted numbers right now. I've actually highlighted the share buybacks in aggregate going on over on the right-hand side of that slide. You can see that shares diluted year over year, that -2 to 3% decline. Those are serious distortions in the diluted growth. So whenever you're looking at growth in this type of environment, we tend to look at aggregate numbers. And you can see the trailing 12 months going negative, and then if you look out the green columns there, June 16 through March 17, we start turning fairly rapidly. And this is what I've been keeping my eye on. So, anecdotally, I read the Wall Street Journal, I look at Sheraz's reports and all of our internal generated research, which is great. And then I take it to the ZRS system and just make sure that the numbers that I'm looking at are actually backing what everybody's talking about. In fact, it's trickling through. So it's a good thing. Low comparables for us definitely help raise the bar in terms of growth. Next slide, please. So moving on to the number 2 reason to remain bullish is U.S. jobs are plentiful despite Friday's job report miss of 160,000 gain in payroll versus the 200,000 headline. the labor market is actually stronger than that 160,000 job addition would suggest. So we had a couple really good bright spots that are worth noting. Average hourly earnings increased 0.3% from the month prior, and that actually represented a 2.5% annual gain from the prior year, same period. And the business and white-collar job postings were large gains. So it wasn't just low-paying retail jobs that actually drove those April numbers. The chart shows as long as the U.S. non-farm payroll workforce keeps building, the U.S. stock market rises. You can see that the S&P 500 has literally gone sideways over the last year, but the U.S. unemployment rate continues to improve, smoothly. So we've got payrolls continuing nicely, and we are sitting at, right now, U.S. unemployment holding steady at about 5%. You can go to the next slide. I believe that one's my unemployment rate slide. So again, non-farm payroll additions are strong. We haven't seen these sort of unemployment claim lows since 1973. I think the U.S. economy probably has at least 12 months to go before we get to that 4.5% number, and that number is very significant. At the top of the last cycle, the U.S. unemployment rate peaked at 4.4 in March of 2007. And that unemployment rate went sideways for probably 6 months before declining very rapidly for 12 months into the fall of the 2008 financial crisis. And I want to make sure everyone's aware that, in 07, 08, we obviously had a clear macro stress point. The U.S. housing market was fracturing at an accelerating rate. We really don't know what that fracture is now, right? Oil prices are firming up. We're going to talk about that in a bit. And China has also turned up. We're going to talk about that in a bit. So, the picture, as long as we can continue with this level of employment and unemployment and the addition of jobs, we're looking at a bullish scenario. Next slide. So kind of to take the flip side of that argument, we can talk about at least one of 3 conditions that have traditionally been met with a bear market. The first one is the extreme consumer price deflation. So global markets have come close, but certainly not here in the U.S. The top slide on this 1 to 4 panel chart shows the CPI less food and energy sitting at about 2.2. Fed target is 2%. The bottom slide shows that CPI all items at 1%, showing the collapse of agricultural gas prices showing up in consumer inflation. So it basically halves it, and I really don't see a problem with this. These are really within the acceptable ranges for U.S. Inflationary expectations. So we're at least well on the way to that, and that's something that the Federal Reserve's obviously got their eye on. Next, you got the next slide? Yeah. So the next slide looks at, overvaluation. I mean, are the equity markets overvalued? I've been arguing this for quite some time, that equity markets are not overvalued. We're going to talk more about this in a minute, but when we look at the S&P 500 trading at a 20-year median of 16.5, basically, you can see my stats over on the far right. The MD is median at 16. Currently, we're at 16.58. The real important picture here is the fact that not only are we supporting those levels of forward multiple with a relatively low equity risk premium, I want to give you a segue. That equity risk premium can actually go lower, and that current multiple that we're looking at 16.5 is being supported by that really low level of total equity discount rate that we haven't seen in decades. So I really don't see any issues with equity valuations at this point. Next slide. The next thing that would likely be present is that the yield curve can invert. And we've certainly seen a flattening at the yield curve, but right now, I mean, we're still looking at a positive slope yield curve. I don't see it becoming inverted in the next 12 to 18 months. Obviously, there could be some sort of a black swan event that could change that, but right now, looking at the employment picture and equity valuations and everything else where they're at, I don't see it. Next slide. If we look at alternatives in the fixed income space, it's bear. We've got $6 trillion in sovereign bonds that have negative rates. So, you know, those that are sitting back kind of wondering, you know, what's going on with the market, again, I think that the mantra has changed, right, from don't fight the Fed to the new one where you really can't come up with a decent argument to fight, you know, every country's central bank. I mean, that's just, it just seems to be proving out to be a losing battle at this point. So, you know, alternatives to the equity space are still, you know, limited at best. You know, cash is always an option, but right now, to keep up with inflation, that's not too many alternatives. Next slide. This one's a really compelling argument. Every time we see this scenario play out, you know, we see market rallies play out time and time again. So what we're looking at in this slide is the S&P 500 dividend yield relative to the yield on the 10-year Treasury. And you can see in this particular valuation chart out of ZRS that current metric of 1.17 actually means that you're looking at a 17% premium on a yield of the S&P 500. This is definitely bullish. So every time we see this, you know, stocks tend to rally. Next slide. This one is extremely compelling just from a risk perspective, right? So I want you guys to look at the correlations between these three charts. The very top chart is literally just the price of crude oil. But I want you to see how the price of crude oil drives the spreads in the high yield market. Now, you could grab any high yield spread. Obviously, the ones that have more risk are going to converge at a much more rapid rate. So they all behave the same way. I just grabbed the double Bs and looked at those spreads relative to the 10-year. And as crude oil has recovered since February, I want you to take a look at those spreads. So that's a dramatic risk-on trade, which is very bullish and driving those spreads down. At the same time, I want you to take a look at the bottom panel, which is the forward multiple for the S&P 500. And you can see that obviously we've bounced off of those February lows very dramatically, and you can see that in terms of the forward multiple or the bid in valuation relative to earnings for the market. I will comment that 5.5% double B spread in mid-February is already down to 3.5%. So that's big risk on trade, which is bullish. Next slide. The equity risk premium, I mentioned this a little bit earlier. The S&P 500 PEF12M and ERP are both trading at 20-year median averages, which is important. But the more important part is that we are sitting at the top of the range band for equity risk premium, as you can see in the bottom chart, and we're sitting at the bottom of the PE band for the S&P 500, as you can see in the top panel. So my prediction is that equity risk premium can continue to fall. I know that for those of you that have been on strategy sessions with me, I continue to preach this. I still continue to preach that equity risk premium trend continues down, that we will see ultimately a 2.9% equity risk premium, and that will end up pushing forward multiples on the S&P back up to around 19 times. At that level, I've estimated S&P 500 valuation of roughly $23.75. Small caps and emerging markets have and can continue to rally. We've seen that since the February lows, and this is obviously a good risk-on sign. So, next slide. This one is really compelling, and this one we were able to see going into the first of the year that growth can not only come from China, but look at this cyclical rebound that we've had. And obviously this is old news now, but again, at the end of the year last year, we could see this in the Zacks cyclical proxy playing out. The earnings revisions for FY1, FY2, and FY3, you can see those circled there in the middle, the 6%, 12%, 14% growth acceleration through 18. The dotted lines that I have the arrow pointing up kind of illustrate this next leg up in the economy that the sell side is forecasting. And you can see that the buy side wasn't buying into it until mid-February. So the idea is, you know, what happened, right? We know we had some China infrastructure investments. We had low supply in iron ore that triggered a commodity price rally. but we also had a pretty monstrous cyclical stock rally on the tail of that. And obviously, some of that was triggered by commodity pricing, and you can see it in the next slide. What really happened was the forecast estimates. Go to the next slide. Whoops. One back. There you go. There you go. So the forecast estimates actually ended up bottoming out in mid-February, and since then have stabilized, and we've even seen an uptick for F1, F2, and this is going to be for the cyclical space. So obviously this is very bullish for that group. It looks like we're looking at a recovery and potentially in that next leg up in the economy. Next slide. This is the last point that a lot of chief strategists continue to have bullish outlooks on the S&P 500. And I want to talk just briefly about in ZRS, you have the ability to go into that research tab and get access to all of the market and macro strategy pieces that we write. They're very good, and they do summarize a lot of this material. I've put several bullet points right there in the middle for you. So 5 bulls looked at 8 to 12.9% returns, 6 bulls looked at 4 to 7% returns, and only 3 sell-side strategists showed up as relative bears at 0.5 to 2%. But it's still a very bullish outlook overall, regardless of what you read in the Wall Street Journal and regardless of what you're seeing on CNBC. I know you guys probably have clients that are calling you up on the phone saying, "Hey, isn't this thing getting a little bit long in the tooth?" And it certainly is. The recovery is still drudging along very slowly, but I do see very good signs in the market and in the economy that this thing can continue on a bit longer. So that's it, Terry.
All right, Tim, just as a point of follow-up, help me out with something here. With this whole issue of companies beating expectations, that being good for the market going forward, doesn't seem like investors have been that impressed lately with these companies beating expectations. I took a look at the S&P 500, basically unchanged since earnings season began last month, despite companies topping estimates. How are you looking at that?
Yeah, they want to see growth, and that's probably why I quoted just kind of as a segue to my slides that low bar, low comparables going into next year is a good thing for growth, because we're actually going to start posting some growth now. But they want to see growth. I think what we've experienced over the last year is literally just a valuation catch-up, right? I mean, the Fed took away the punch bowl, and valuations have got to get caught up to the underlying fundamentals. And I think that's what we're seeing. This leg up in cyclicals, the rebound in the oil market, and if China can, at least stabilize and uptick a bit more, I mean, we'd be looking at a pretty positive scenario here. And it'll also help emerging markets as well. So.
Okay. Well, thanks for all of that, gentlemen. Unfortunately, that's all we have time for today. We want to thank our panelists, Sheraz, Mian, and Tim Nyland, and our attendees for dialing in here. If you have any questions regarding our services, feel free to email them to zrs@zacks.com. Likewise, if you'd like to be put on the email alert list to receive Sheraz earnings commentaries, if you want a copy of Tim's top 10 reasons to be bullish, or a copy of the slides featured in today's presentation, same email address applies, zrs@zacks.com, or contact your ZRS representative directly. Until our next call, thanks for joining us, and we'll look forward to the next time we're all together on the call.